Welcome, everybody, to the first full week of fall. And we definitely saw a little bit cooler temperatures than last week. We had in the 80s. It was beautiful here in Michigan. Welcome to the market update desk, Scott Riley and Mortgage One, September 26th. Let's go into what's happening today. There was a consumer sentiment report that came out today. It showed consumer confidence declined from an index rating of 108.7 to 103 in September, which was lower than the expectations, which was expected at 105 and a half. Now, an important component of that was the expectations component fell to 73.7 from 83.3. Now, when we look at what that means is typically a rating or expectation of 80 or below typically foretells a recession in the next 12 months. So we've got what could be the data that supports a recession, yet we still have a lot of people talking about a Goldilocks landing, a soft landing. We're going to have to wait to see how this all plays out. The big report that came out today was new home sales. So the annual sales pace for new home sales came in at 675,000. This was less than expected by about 2.5%. The for sale inventory of new homes was at 436,000 units. Now, this would represent a 7.8 month inventory of new home sales if you just looked at the headline and didn't dig deep into it. When we go into this, it's showing out of those homes, there's 76,000 completed homes, which when we look at that, that really represents 1.3 months supply of inventory, not 7.8. So what you have to look at is not only what's for sale, but what's under contract. In fact, 106,000 of those new homes are actually already under contract and have not even been started yet. So you got to get past the headlines to dig into the data. The next item that came up today was the Case-Shiller Home Price Index. Once again, showed that home prices increased. Contrary to popular opinion, we're still in an increasing market. Showed in July, which is what the reporting was for, up 0.6%. Now, that's about a 7 to 7.5% annualized rate. So we're still seeing significant appreciation nationally. FHFA, the Federal Housing Finance Agency, also came out with their appreciation, and that showed that homes went up at a rate of 0.8% in July, and that's almost a 10% run rate year over year. So we're seeing continued strength in the housing sector, and that likely won't change. For example, if and when rates do come down, probably the middle of next year, you're going to see that those home prices are anywhere from 6 to 10% more than what they are right now. So it's not the rate that matters. It's getting into a house and letting appreciation work for you rather than against you. Other part of what moved the market today is this afternoon, Minneapolis Fed President Kashkari came out and said, we may need to have significant increases in the federal funds rate to start to show inflation. Yeah, that definitely did not help the bond market. We started out positively today, but we've retreated and we're still over the important 4.5% rate on the 10-year Treasury, which is a very important resistance level. If we can get some positive news, meaning a weaker than expected jobs report next week, we could see some substantial movement in the bond market and potentially in the mortgage-backed securities market. So we're hoping for that positive news next week for the market. In fact, all three indices are down today. The Dow, the Nas, and the S&P are all down today. So we're kind of treading water here, hoping to get some market moving news in the positive direction, not in the negative direction. We will keep you updated on everything. Please do me a favor, like, share, give me comments on that. In fact, we did create a YouTube channel also, the Market Update Desk. If you could follow that, we'd appreciate it. Give us a call with any questions, 616-293-2189. Have a great afternoon.